Good afternoon, everybody, and welcome to the Elite Traders Club education session for October the 7th, 2015. Today's topic is soft stops. The reason for picking this particular topic is I've been doing a lot of thinking over the last few months in relation to the use of soft stops and whether having a secondary rule on a breach of a soft stop is a good thing, or whether there's perhaps a better way that we can manage the use of our soft stops when we're trading. Obviously, it's up to each individual, their own discretion as to whether they prefer to use hard stops or soft stops. But I think it's worthwhile discussing the use of soft stops, and hence the topic for today. So let's get underway. Obviously, the first thing we need to cover is the disclaimer. The content of today's presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, or particular needs. So please, before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances. Okay, so soft stops. The topic for today, obviously, we need to use some form of protection when we're investing in the markets. And there's two schools of thought. Some people like to use what we would commonly refer to as a hard stop. So perhaps the first thing to do today is really just to go through and explain the difference between soft stops and hard stops. Effectively, a soft stop really isn't a stop at all. Unlike your traditional hard stop, a hard stop is an order that's placed in the market, and when price gets to that particular level, it's triggered, and whatever price that stock is trading at that time is your final exiting price. Now, sometimes you can get, if the market is moving very, very quickly, then you can get a degree of slippage. And sometimes slippage can work for you, sometimes it can work against you. The whole concept of soft stops was something that's I guess over a period of time has been considered, and they were introduced into the Elite Traders Club probably about a couple of years ago. And the reason why they were introduced initially was that clients were finding out that in setting their initial stops, that quite often price would come down during the course of a week if they were trading weekly charts, or in the middle of the day if they were trading short-term using daily charts, only to find that their hard stops were being triggered, they were being kicked out of the trade. The market would, according to Murphy, would then rally, resulting in the price moving back up above where their initial hard stop was situated in the market, and end up closing up higher for the day or higher for the week. And so as a result of that, being humans, we're emotional creatures, and as a result, leave you with a bad feeling in your mouth, knowing, look, you've done the right thing, you've tried to use a degree of capital protection by putting in a hard stop, only to see the fact that the market's come down, tickled your hard stop, turned around, found some demand there, and ended up higher. So the concept of a soft stop was introduced, whereby rather than putting that stop into the market on your trading platform, it's really just a mental stop, if you like, a note on a piece of paper or in your trading journal or wherever you choose to keep your reminders, in a diary of some sort. It might be on your phone. And it's really just an intention to sell at that particular level. So from that point of view, if a soft stop happens to be breached, then it's a call to action, and you need to start thinking about what you need to do. And so we've had some rules as part of the Elite Traders Club that helped us to take some action once our soft stops had been triggered. So we'll get to that in a moment. But one of the main reasons for using the soft stops in particular is just because of market volatility, prices coming back down and then moving back up during the course of the day. There's certainly pros for them, but there's also some cons against them as well. And I think the main thing is, no matter what sort of stop you're using, is the need to be consistent in your application of them. So if you're a person who likes to use hard stops, then by all means continue using hard stops. Nothing the matter with doing that. If you're a person who uses soft stops, then just be disciplined and stick with your soft stop rules, or your soft stop use as you go through. So try not to flick between the two. Sometimes, depending on market conditions and degrees of volatility, sometimes you're going to be thinking, "Oh, I should have used a hard stop," and there'll be other times when you think, "Oh, I should have used a soft stop." So rather than swing between the two, just be disciplined, make a rule for yourself, and stick to it. Otherwise, you're going to find yourself chasing your tail forever and a day, and you're never going to get used to managing your trades in a very simple and a complete manner. All right, so let's perhaps have a look at some charts and talk about some examples of where we've used soft stops. And remember that all the stops that we've used through ETC and in the watch list have all been soft stops. So I think it makes sense to give a little bit of context to this and have a look at some key examples. So there's a number of stocks recently. Obviously, with the beginning of September, we had a very volatile month on the markets. And it's probably a good point to discuss the exact use of stops, because when you get extreme volatility like we had at the beginning of September, you might remember the big night on Wall Street where the Dow at one stage was off 1,000 points. Stocks were gapping down all over the place. So it's a great environment, a great context, a great backdrop to think about the use of hard stops and soft stops with that as a medium. Those sorts of events occur every now and then. It's not a normal type of event, and you can't really prepare for that extreme volatility. So that's something that I think you need to have in the back of your mind, but you certainly do need to prepare for stocks going in the opposite direction. So typically what we would do when we have a soft stop, our initial 2 ATR based stop, I'll just move that value line out of the way for the moment, and just go back over some trades that have been stopped out recently, or ones that have been close to stopping out, and see if there's anything that we can pick up from the use of either a soft stop or a hard stop, or our existing soft stop rules. So we had a stock here, it was VRTU, and you can see up here, we've still got the analysis on it. It was a non-stop order at 52.06 with a limit to 52.58, and the initial protective stop was at 47.62. So that's the thick red line, the 47.62. Now, no sooner than being triggered in on this black candle, we had another black candle the following week, which actually came down and breached the initial 2 ATR base stop. Now, remembering we're using an initial 2 ATR base stop because it gives us the biggest bang for our buck, if you like, based on our level of risk. So we've got our 2 ATR base soft stop in there. It was breached, and so therefore the existing rule has always been, once we've got a breach of the soft stop, we need to then take action immediately and convert the soft stop into a hard stop. So the previous rule up to this point has been we need to put in a hard stop 0.5% below the low of the candle that breached the soft stop. So in that particular instance, we had to put a hard stop 0.5% below this black candle with the long wick, and so therefore we had a hard stop coming in at 46.32. So from that point of view, we're just waiting for the next few periods of time go by to see if price comes down and triggers that hard stop that's on our platforms and sitting in the market. So what happens? Price recovers a little bit the next couple of weeks, and then it starts to turn down again. And when it turns down, it eventually comes down and breaches what is now a hard stop. So on that particular week, again, a little bit of Murphy's Law, isn't it? That price came down. It triggered that hard stop only to close right up on its highs or very close to it. So a very bullish candle there. So in this particular example, converting what was initially a soft stop to a hard stop once it had been breached, it didn't really do us any favours in that example. Since then, the stock's moved up. It's had a little bit of a retracement, and generally, by and large, is looking reasonably strong. So is that enough evidence to make a case for one way or the other? No, it's not. We need to have a look at a few more examples. So let's go through and have a look at some other trades that have been stopped out over the course of the last couple of months, and do a little bit more investigation. So another trade set up here again. You'd all be familiar with the concept of troughs at or above, second from last peaks, great relative strength, etc. We got pipped into this trade on the very first week after the trade was set up. Since that particular point in time, we have our soft stop, our original soft stop in there at 34.65, which is this red line down the bottom here. Now what we need to do is see whether or not this particular candle has breached our initial soft stop. So our soft stop was sitting in there at 34.65. The low of that black candle was 34.63. So in that particular instance, that soft stop has been breached, and therefore it needs to be converted into a hard stop. So on that particular example, then what we need to do is put in a hard stop 0.5% below the low of that candle. So let's go through and let's just get out the calculator and do this for as an exercise. So I'll just grab my calculator, and with a little bit of luck, bring it onto the other screen. There we go. There it is there. So let's just go back to the low of that candle. It was 34.63. So 34.6. Do that again, David. 34.63. And we've got to take off 0.5% of that. So we multiply by 0.995 and we get 34.45. So 34.45. So if I just go and put in a horizontal line there at 34.45, 34.45. Now what I like to do is make that a thinner line and change it back to red so I know it's the protective stop, and putting that in. So you'll see there, and I'll just try and blow that up a little bit so we can see that a little bit closer, that now is what a hard stop is, only just a little bit below the low of that candle. So in that particular instance, we had to wait to see whether price was going to regain any strength or not. We had a follow-through candle, which was quite strong, and then we had a weaker candle. And then that last week in August, a lot of volatility in the market, and price during the course of that week came down. It actually, from this previous candle, the close at this level, the following week the candle actually opened up pretty much right on our new hard stop. So that triggered us out of that particular trade. And since then, the stock has, again, regained a fair degree of relative strength and has been moving up, doing a reasonable job given what the rest of the market has been doing. So in that particular example, converting a soft stop to a hard stop had us triggered out during that downward move. All right, so let's go and have a look at another stock. Here's an example of Leggett Platt. An example of a trade set up through this particular level here. Really nice candles, good trade structure. We triggered in onto the trade, and then again, as often happens, we got triggered in, we had a retracement. So in this particular example, our price came down, and we'll just check and see whether or not it touched our initial stop there. Our initial stop was at 47.18, and the low there of that particular day was 47.26, so that didn't hit our protective stop. The following candle, though, it did. So we had a low there of 47.01. So at that point, what we need to do is go and convert that initial soft stop into a hard stop, and we do that by putting in a hard order 0.5% below the low of the candle that breached it. So the following week, we had a white candle and things were starting to look good. Now we just need to see how low did that candle go. Did it go down to $46.77? The low there was 46.88, so we haven't breached that hard stop. The following week, however, you can probably see the tail of the candle there, piercing that what is now a hard stop, and we got kicked out of the trade. So in that particular example, we're out of the trade, and then we had that volatile week at the end of August, beginning of September, where the price gapped down even further. So just going through some examples of soft stops being converted to hard stops. We'll go through a couple more, and then what we'll do is we'll just go through and have a look at how we might choose to manage our trades in a slightly different manner. Another example, DG, Dollar General. Again, nice structure of the trade, good relative strength, etc. And very similar to a lot of the other stocks at this point in time, that there was a degree of market weakness where the market was moving largely to the side. So in this particular example, again, being triggered in, stock starting to show a little bit of weakness, a little bit of underperformance, and then price coming down and triggering our initial protective stop, so our 2 ATR based soft stop. So in that particular example, according to our rules, it says that we need to put in a hard stop 0.5% below the low of the candle that breached the soft stop. So now we have to put in a hard stop 0.5% below the low of the candle that breached it, which is this big white one, and that's where our hard stop is. So we now sit there waiting for price to eventually trigger us out of the order, kick us out on the negative side of the equation, down at around about $69.99. Now, if you have a look at the initial risk on the trade, that is the difference between our blue line and our red line, and where we're now looking to get out of the trade, they're almost equal. So in many of our trades as part of ETC, the average stop loss is around about 10%, just roughly, in price. So that means now that instead of having a risk of 10%, we're nearly getting a risk of 20% by the time we finally get kicked out of the trade. Now, I don't think that's a good thing. Certainly giving back a lot more than we were initially prepared to take on. So that's an example there where we've actually ended up with a pretty bad outcome. We only just got triggered into the trade, and rather than being kicked out at a level fairly close to our initial protective stop, the soft stop, we've really suffered a fairly severe loss on that trade. Let's go through and have a look at another couple, and then we'll go back and have a look at some simplified rules. SNPS was another one. I'm not too sure whether any of you guys have been in any of these trades along the way and thought about your use of protective stops and how you're actually managing them, or whether you're indeed following your trailing stop rules, your soft stop rules, etc. I think it's something that you need to be very comfortable with, because certainly it's the exiting of your trades that's going to make all the difference. And certainly we want to make sure that whilst we're letting profits run, that we're doing our extreme best to cut losses very short. SNPS, so we got triggered into the trade. I think it was on this candle through here. Price went sideways for a period of time, and then we had a fairly large dark candle again getting towards the end of August, when volatility really started to increase. You'll see that it actually closed below our initial soft stop. So that means that we need to therefore convert that soft stop into a hard stop by putting in a hard order 0.5% below the low of that candle. The following week, when the market was gapping down, that's this particular candle here, it gapped down, and the open of this candle is down. If I can put hold the cursor there, you'll see that the open there was at 45.37. The close of the previous candle was 47.52. The open down here 45.37. So prices gapped down quite a significant way, and at the same time actually gapping past our initial hard stop order. So in that particular example, we suffered a bit of slippage in that example. Since then, prices started to come back up, but again, starting to weaken and relative strength disappearing as well. And I think we've got two more that we'll go through, have a very quick look at. The same sort of thing. Initial soft stop through here. Once it was breached, we had to put in a hard stop. And then a few weeks later on, and again it was during the volatile markets, that this white candle, it gapped past our hard stop. Remembering this, the candle closed the previous week there at 51.49, and the following week opened up at 48.48. So our order sitting in there as a hard stop gets triggered at 48.48, and therefore again suffering. If we think about the initial risk on the trade between the blue line and the red line, and where we end up getting out, instead of risking 10% and being prepared to lose 10% if it goes the wrong way, i.e. in terms of price, whatever that level of risk is, whatever 1R is for you, you've lost in this trade nearly 2R as a result of that. So it just bears thinking about in terms of what we need to do when using soft stops. Is there a better way that we can get a better outcome than converting to a hard stop? So what I want to do now is I want to go through the exact same trades and just have a look at if we have used exactly the same rule that we use for our trailing stops. Now remember, the trailing stop rule is if price closes below the trailing stop, then we exit at market the very next period. Okay, so obviously we're using weekly candles, so that means next Monday, either Monday morning in the Australian market or at night time in the US, we place an order to get out at market. So interesting, again, it's the same time frame, so we've got to deal with this excess volatility that we've had, and I'm curious to see whether or not using a simpler rule would benefit us in our exits. So let's go through exactly the same trade setups. So VRTU. So the suggestion that I'm putting to everybody is that if we use exactly the same methodology that we use for our trailing stops, it means that when price closes below our initial 2 ATR based protective stop, then we exit at market the following period. Let's have a drink. So in this particular example, all we're waiting for is price to close below our initial 2 ATR base stop. Now this candle, in the first example, remember it breached our 2 ATR base stop, but it did not close below it. The next candle closed above it, so did the next one, the next one, the next one, and ever since this particular candle, our price hasn't really looked like closing below it. So that's a trade that we would still be in, VRTU. Okay, even during that excess volatility that we had towards the end of the month in September, end of August, beginning of September. Next example. So again, our rule, if price closes below our initial 2 ATR based soft stop, then we have to exit. So in this particular example, yes, we had a breach of our soft stop, and again you'll see the volatility coming through at the end of August, beginning of September. Price came way down and closed above our 2 ATR based soft stop. Did price close below it? No, it didn't, and we're still in the trade. Another example, LEG. Let's see what would have happened here. So we triggered in, we're waiting for price to close below our thick red line, which is our initial 2 ATR based protective stop. So let's just have a look at this candle here. The close of that candle is 47.08. 47.08. Our initial protective stop on this trade was 47.18. So that stock there closed below. So therefore we need to exit at market the following day. Now what happened? Well, the following day we ended up with a gap down in this particular example, and price opened at 44.64. Okay, 44.64. So there's an example where price closed below, getting out at the open of the very next day. We ended up with some slippage, some big slippage, because we had that extreme week on the markets. Okay, so there's a case where it perhaps didn't work for us. The previous result, when we converted a soft stop into a hard stop, we got triggered out on this particular candle, so we wouldn't have suffered the slippage that following week. Let's have a look at another example, DG. So again, when has price closed below our initial 2 ATR based soft stop? Well, we had a big gap down here, ended up with a white candle at the end of the week. So that was a candle that almost went a little bit counter to the rest of the market. Big gap down, but then closed very strongly and actually closed at 74.84 above our initial soft stop at 74.58. So nothing to do on that one. The following week, however, price closed below. Price closed at 72.56. So that means that we need to exit at market the following period. So it closed there at 72.56. It opened the following period there at 73.52. So 73.52 was the open there. The close there was 72.36. So market moved up a bit over the course of the weekend, and we got out at a slightly higher price. So that's DG. If we had to wait for, conversely, the hard stop to be triggered, then we end up being triggered down at 69.99, nearly a 2R loss compared to around about slightly over, sort of about 1.25. So working in our favour in that particular example. SNPS, when did price close below the 2 ATR based soft stop? Well, it did on this particular candle, the black candle there. So the close there at 47.52. It means we need to get out at market the very next day. Again, very volatile market, so we need to think about this. Where did price open up? It closed there at 47.52. It opened up at 45.37. So we got some slippage occurring on that particular day. So there, because we got that gapping down, whether we had a hard stop or a soft stop, we got exactly the same outcome because of that slippage. SPR. So initially, now this was a candle that breached the initial soft stop, converted to a hard stop. Remember, that's the fine line there. Our rule, a simple rule could be when price closes below. Well, price closed below on the black candle, so therefore it means that we need to get out at market the following period. So when the following period opened, again, remember the volatility that we had. The price opened all the way down here. Price opened at 48.48. So whether we got out at market the very next period or whether we used the old hard stop, that hard stop was gapped past and we got out at exactly the same sort of level. So again, it's all about, when we're thinking about the last few weeks, all that volatility and its overall impact. So again, getting out at the extreme lows there, using both methods, you're going to end up with, instead of a 1R loss, close to a 2R loss. Let's have a look at another example. GIL. So as price is coming back down, we get a close below the initial soft stop there. We therefore need to convert it to a hard stop. And again, because the market gapped down, we got exactly the same result, getting out at market the very next period. Because the market gapped down, it gapped over what would have been a hard stop in the market. But at the end of the day, it's closed back up above where that hard stop would have been. So that would have been quite frustrating during that particular week, seeing your order triggered and a white candle forming as a result. So exactly the same outcome, again, because of the market gapping in this particular example. So again, getting close to a 2R loss. And again, what you need to remember is that this is against very major significant up and downward movements in the market. So really extremes in volatility, but it certainly bears worth thinking about. Another example here where we had a gap down below our initial soft stop. So this is the white candle here. It's gapped down below our initial soft stop. So therefore, we need to convert to a hard stop. That's the thin line down the bottom there. If our rule is to get out when price closes below our initial soft stop, let's see where in that particular example, the price closed on that day at 96.25. That's on SIRO, 96.25. And if we can just scroll to the side there, you should be able to see that. 96.21 is where our initial stop loss was. So price has actually closed above it, 96.25. The following week, however, price closed below it at 94.07. So that's the candle that closed below it. So what we need to now do, because price is closed below our soft stop, we need to exit at market the following period. So the close there was 94.07. The open the following period is $95. So in that particular example, we're getting out at that level, a little bit below our initial 2ATR based soft stop. But we've still got in here, according to our traditional rules, a hard stop all the way down at 90.46. So if we end up getting stopped out down here during the course of this week, then we're going to have another nearly 2R based loss compared to a little, a little bit over a normal 1R based loss. So again, I just want you to think about the impact of volatility during all this, because this is really worst case type of scenario. In actual fact, a good exercise for you to do is to go through and have a look at some of your own trades and have a bit of a look at the concept of using the soft stop methodology, i.e. when price closes below it, as a metric to get out, as opposed to converting your soft stop into a hard stop. Here's an example that I think probably goes to show the simple logic that we've got a stock here, BIO, initial 2ATR based soft stop, price has come down. It's got very close to the initial stop there. 139.66 is where the stop is. The low there, 139.98. So nothing to do on that particular week. The following week, however, again, during all the volatility, the close on this candle, 139.52. Well, is 139.52 lower than 139.66? Yes, it is. So on that particular candle there, we have to exit at market the following period. The following period, price opens up at 139.52. So let's just put that in there, 139.52 at that particular level there. So again, we've had a little bit more than a 1R loss, probably getting close towards 1.5R loss. But according to our traditional rules, you'll see that we've got our hard stop in all the way down at 130.59. So if that happens to get triggered, we're going to end up with close to a 2R based loss. So again, really wanting to keep losses small and let those profits run. And I think it's really important that you find a methodology that you're comfortable with, but also look at it not just in a range of, not just in one particular market condition. See what would happen in some extremes as well. Because what you'll find is that typically in low volatile markets, so low volatile markets when the market is rising, and I can give you an example of that along the way, but during low volatile markets, you'll find that your soft stop use of soft stops actually saves you a number of times and really does allow you to get some quite significant runs on the board, whereas you're likely to find that your hard stop potentially prevents a couple of those going along the way. The flip side of that is obviously that sometimes being stopped out earlier can also prevent some slightly bigger losses along the way. So, but over the longer term, it's my belief that you'll find that your soft stops will serve you pretty well. So what I might do is just go through and just bring up the index for a moment. So I'll just bring up the indices there. So the a little bit of luck. Come on, Beyond Charts. There we go. So there's our market risk model, etc. And I've made an overlay, and I think I've still got it in here. Let's have a look at that one there. Let's see. That's on, I'll just move that back to a daily basis. Okay, so what I've got on here, this just shows the volatility. So this is our traditional stochastic that we measure market risk in. This little wiggly line along the bottom here, this is basically a percentage volatility. And what it does is it just shows us the degree of upwards and downwards movement. So you've got to remember that volatility is not in any particular direction. It's movement up to the top side, up to the upside rather, and to the downward side. And what it's saying, as this little green line is moving further and further up, that we're getting bigger swings in the market. So what you'll find is that if we go back over a period of time, that there's periods where market volatility, and this red line is just a moving average, a 63 moving average of market volatility, that when volatility starts to increase, if you like, what sort of impact that might have on the use of your stops, your trailing stops along the way. When you get periods of low volatility is when this green line, that's our percentage volatility, is below its longer term moving average, if you like. So through this period of time, you'll see this is basically saying that from beginning of 2014, pretty much through to about September of 2014, we're in a fairly low volatile type of market, and that's where your soft stops in particular are going to be very useful for you. What you will find that low volatility begets high volatility. Okay, and high volatility begets low volatility. So that's something to think about along the way as well. So if we go back over a period of time and have a look at when are there other periods of low volatility, you'll see through 2013 when volatility, this is obviously a point during 2013 which may have had some, I think from memory, back at the time when Bernanke was doing QE and all those sorts of things prior to that particular level. We had a high volatility and the market really coming down. Then volatility, after this excess volatility, it really dropped off. Okay, so volatility really, really low through here. And what happened to the market at the same time? Okay, so nice steady upward movements. And again, that's where your use of soft stops in particular is really important, because your soft stops are going to allow you to get those big runners along the way. So really just wanted to point out the, I guess, a couple of things there. Whether you choose to use hard stops or soft stops is up to you, but be consistent in your application of it is really, really important. And just think about the markets as well, because when you're in a low volatile market, and again through periods of 2012 into 2013, you'll see that the volatility has really come out of the markets, and you'll see just such a nice trending market for a long period of time. And this is where it's really important to bank those profits, those really big ones along the way. Let them run, and your soft stop's very, very good for doing that, so that when volatility does start to increase, and you'll see that as it starts to move up through here, the other aspect of it as well, you'll start to see your stochastic indicator starting to come down as well, and that'll start you stopping out of, getting you stopped out of trades and things along the way, and that's okay. All good things come to an end, and volatility is starting to increase as well. So, certainly at the end of your trends, that's when you give most back. It's just a common fact. That's when you give most back, and that's why it's so important to really let your profits run so that you're making good money while that's occurring. As we start to get an increase in volatility and market risk starts to increase, you'll start being stopped out of some of your trades, and depending on how quick that is, it will depend on how much you give back at the end. So I hope that makes sense. I've sort of done my best there to give you a bit of an overview of the pros and cons of both hard stops and soft stops in particular. Certainly I use soft stops myself because I believe that the benefits outweigh any disadvantages along the way. You know, obviously the flip side to that is when you get some extreme volatility coming out of nowhere, sometimes you can end up giving back a little bit more than what you were first anticipating. So I'll wrap it up there, folks. If you've got any questions, type them in. If not, certainly more than happy to answer any questions over the phone, or if you want to drop me an email or anything like that, and we can explain, go over the concepts a little bit further for you. David's asked, what is the volatility indicator? It's just an indicator that I made up myself, David. It's basically what all it does is it measures the volatility or the up and down movement of the actual index. So I'll just give you a quick look in. I think I've got it in here, percentage volatility. And I'll just right click and click on edit. And that's the formula. So you'll be able to see that there yourself. Again, because it's recorded, you'll be able to go back and type that into your own Beyond charts if you want to. And all that does is it just gives you a percentage base of the volatility of the index. And then when you go back and have a look at it, you can put on a moving average of it if you like. I've just got on there a 63 period moving average. It just gives you a look back period and says, well, look, how is the volatility compared to the last 63 periods, in this case 63 days. So so go through and have a little bit of a look and see what you think. All right, folks, that's it for me. Thanks, Will. Thanks, Kay. Sounds like I've given everyone some food for thought. So that's the main idea. Again, just to get you thinking a little bit about the impact of volatility and the pros and cons of whether you choose to use a hard stop or a soft stop. And at the end of the day, keep it as simple as you can and just be consistent in your application. That's all you can do from a trading perspective. Until next Wednesday, I hope the markets treat you well, and remember to follow your rules. Bye for now.